Hi, Professor. My name is Fatima Gambari, and today I'll be presenting on Lyondellbasell, one of the world's largest plastics, chemicals, and refining companies. Lyondellbasell is headquartered in Houston and Rotterdam with operations in over 100 countries. Its diverse portfolio, ranging from plastics and packaging to construction materials, automotive parts, and electronics, and it makes it integral to global industry. Because of its scale and reach, LYB is often regarded as a barometer for worldwide industrial demand. A major growth project for the company is Flex 2, a large ethylene expansion project in the US. Um, Ethylene is a critical building block for plastics and many consumer goods. Flex 2 was designed to capitalize on low-cost shale gas feedstocks, but on August 1st, 2025, LyondellBasell announced it would defer this project, cut its 2025 capital spending by about $200 million, and begin talks to sell certain European assets. This decision sent a powerful signal to capital markets. The company was prioritizing financial discipline over growth. Investors reacted immediately, with the stock dropping nearly 8% in a single day. In this chart, it shows the company's earnings volatility over the last three quarters. In quarter 4 2024, LyondellBasell posted a net loss of $603 million. This wasn't just a small miss, it was a big red flag. The company had to take over 800 million in impairments, especially in Europe and Asia, reflecting weaker assets in those regions. Investors began to question how sustainable the company's global footprint really was. In quarter 1 2025, things looked better with 177 million in net income, but analysts noted that margins were still under pressure, especially in olefins and polyolefins markets. Then came quarter 2 2025. Profits dropped again to $115 million. This was far below what investors expect from a global leader in this sector. So by the time August 1st arrived, it was clear. Earnings were too weak to support aggressive expansion. That's why Flex 2 was deferred and capital spending cut. Now let's look at how equity markets reacted. On July 31st, LYB's stock closed at $57.93. On August 1st, after the announcement, the price dropped to 53.42, a 7.8% decline in one trading day. That is a huge move for a large cap industrial company. Over the following week, the decline continued. By August 8, the stock was down to 49.06, almost a 15% total drop in less than 10 days. This wasn't just a short-term overaction. The market was repricing the company's risk profile, lower growth, weaker cash flow, and higher capital costs. It also tells us something important about how capital markets process information. Investors didn't just react to the earnings miss, they focused on the deferment of Flex 2 and the signal it sent about the global cycle. That's why the sell-off lasted beyond the initial day. Here, we see how management reshaped their capital spending strategy. Originally, Lyondellbasell planned to spend 1.9 billion in 2025. On August 1st, they cut this to 1.7 billion, a 200 million reduction. For 2026, they went even further, targeting only 1.4 billion. This isn't just about saving money, it's about reprioritizing projects based on new financing realities. Projects like Flex 2, which require billions in upfront investment, were suddenly no longer viable under higher cost of capital conditions. At the same time, the company announced exclusive talks to sell European assets. Europe is their most challenged region, with high energy prices, strict regulations, and weak demand. Offloading assets there could strengthen their balance sheet and free up capital for more profitable regions. When a company like LyondellBasell faces volatile earnings and impairments, investors become more cautious. Equity holders demand a higher risk premium, while bond investors widen credit spreads. Both of these push up the company's weighted average cost of capital, or WACC. Here, WACC rises from about 8.5% to 9.8%. That may sound small, but in corporate finance, it makes a huge difference. For example, a $1 billion project like Flex2 might have looked profitable when WACC was 8.5%. But once hurdle rates climb over 9 or 10%, that same project can no longer meet return requirements. That's the direct link between capital markets and corporate strategy. A higher WACC forces companies to delay, defer, or cancel projects. That's exactly why Flex 2 was deferred on August 1st. Looking back to quarter 2024, the company recorded significant impairments. 769 million in the Europe, Asia, and international segment, and 42 million in advanced polymer solutions. These weren't just accounting adjustments, they revealed deeper structural challenges. Once Europe's energy crisis has made many assets uncompetitive, and Asia's lower growth, especially in China, reduced demand for petrochemicals, and APS, a smaller segment, showed that even specialty chemicals weren't immune. For credit analysts and equity investors, these impairments were a signal of regional fragility. They suggested that future cash flows from these areas might not support debt service or dividends. By August 1st, these risks were already well known. The capex cuts and Flex 2 deferral confirmed that management was shifting toward defense mode, which markets had been anticipating since those write-downs. Finally, let's zoom out to why this event mattered globally. Lyondell-Basell operates across three major regions: U.S. feedstocks, where shale gas provides low-cost ethane; European production, where high energy costs and regulation squeeze margins; and Asian markets, where demand growth drives sales of plastic and chemicals. When LYB cuts investment and defers Flex, so it's not just about one company, it signals broader trends: equity markets, credit markets, and commodities. In short, what happens at Lyondell-Basell is a proxy for the global cycle. The August 1st decision confirmed what many feared, and that the global chemicals market is in a slowdown and companies must conserve capital. This is why the event had ripple effects far beyond LYB's own balance sheets. And these are my references. And also, thank you for your time.